Investors were also caught off guard by North Korea today. There were reports that that country has indefinitely postponed high-level talks with South Korea, which were scheduled for tomorrow. The North Koreans were reportedly upset about a previously scheduled joint South Korean-U.S. military drill. It is unclear what impact this may have on President Trump's scheduled summit with Kim Jong-un on June 12th. So what does all of this mean for the markets? Joining us tonight, Ken Mahoney. He is here to talk about all this. He's CEO and president of Mahoney Asset Management. Ken, always good to see you. Thanks for joining us.
Good to see you too, Bill.
You're inclined to buy dips like today, right?
Absolutely.
Why?
I mean, the fundamentals haven't changed. The real story is about earnings, earnings, earnings. You know, real estate, location, location, location. For the markets, it has to be about earnings. And the earnings are very strong. And companies guided higher for the most part. And companies also have a lot of earnings because this tax windfall they have that they can buy back stock or pay more dividends. All pretty positive for the markets.
But the environment's changing. Rates are going up.
Yes.
I mentioned the 10-year now above 3.07%. Does that worry you at all?
A little bit, but like how we got there, it's not because of inflation, it's because of growth. It wasn't just that 2 months ago people were saying, hey, we get a 3%, this market's going to roll over. You know, today 1% down is not really rolling over, so to speak. So, you know, again, if it stays up here and goes higher, we'll have to watch that because bonds are competition then to stocks. But the same token, if you think about it, just a couple months ago, we hit 3%, that was magic. The algorithms are going to start making the market cascade. That didn't happen.
Geopolitical concerns, the trade issues that we face right now. None of this we were talking about last year. It was all about earnings for the most part last year. Now we have all these different concerns for the market. What about those as well?
There's definitely a lot of headwinds. And you compare, you know, this year to last year. Last year was an anomaly. Most people are saying, wow, this is crazy this year. All this volatility. We've had two 10% corrections in 2018. Guess what? 2018 is more normal of a market than what happened in 2017.
Right.
The biggest drawdown we had in 2017 was only 3%. So, you know, you do expect these headwinds, and we have this kind of push and pull going on.
So when you get this kind of a dip, what do you buy? What do you like right now?
I like technology. I like large cap. Technology, because we're getting top line growth. Companies are still growing their sales numbers. Most of the other industries are making their numbers because of EPS, meaning they're buying back stock, they're hitting their numbers. But really, if you look at technology, they're still growing in sales, and that's where the action is.
But you're not betting on the consumer right now.
No, not at this point. I mean, the consumer staples has been a laggard. I think there's some branding things that's going on. There's some undercurrents. I like to go where the leaders are. That's where the pin action is right now, is technology. Yes, they're more volatile than most of the other sectors, but that's where the growth is, and that's where investors can be attracted to, is where there's going to be some growth.
I know you're investing for growth. A lot of our viewers invest for income, but with rates rising, it's tough to find a safe investment there, or relatively safe. Where do you go?
Well, again, there are those tips, you know, that trade along with that. There are those different type of investments, ETFs, rising rates, floating rates type of thing. Those type of ETFs do give, you know, some type of immune off those higher rates and lower bond prices.
All right. Ken, always good to see you. Thanks for your thoughts tonight. Ken Mahoney with Mahoney Asset Management joining us this evening.